Unveiling the Sarbanes-Oxley Act, a game-changer in corporate governance. 1. Introduction. Restoring trust in corporate America. The Sarbanes-Oxley Act, SOX, enacted in 2002 in response to corporate scandals, stands as a pivotal legislative initiative aiming to enhance corporate governance and financial transparency. In this exploration, we delve into the Sarbanes-Oxley Act, its genesis, key provisions, and its profound impact on the landscape of corporate governance. 2. Genesis of the Sarbanes-Oxley Act. Corporate scandals. The early 2000s witnessed high-profile corporate scandals, including Enron, WorldCom, and Tyco, which eroded investor confidence and highlighted shortcomings in corporate governance and financial reporting. Call for reform. In response to these scandals, the Sarbanes-Oxley Act was introduced as a legislative response to address corporate malfeasance and restore trust in financial markets. 3. Key provisions of the Sarbanes-Oxley Act. Section 302 mandates that CEOs and CFOs certify the accuracy of financial reports and disclose any significant changes in internal controls. Section 404 requires management and external auditors to assess and report on the effectiveness of internal controls over financial reporting. Section 401 prohibits personal loans to executives and directors. Section 802 imposes criminal penalties for altering, destroying, or fabricating records with the intent to obstruct federal investigations. Creation of the PCAOB. The Public Company Accounting Oversight Board, PCAOB, was established to oversee public accounting firms, ensuring compliance with auditing standards. Enhanced financial disclosures. SOX requires more comprehensive and timely financial disclosures, reducing the information asymmetry between management and investors. 4. Impact on corporate governance. Strengthened internal controls. SOX places a significant emphasis on the establishment and maintenance of effective internal controls, reducing the likelihood of financial misstatements and fraud. Increased accountability. The certification requirements for CEOs and CFOs foster a culture of accountability, with executives held personally liable for the accuracy of financial reports. Audit committee independence. SOX mandates that all members of an audit committee must be independent directors, minimizing potential conflicts of interest. 5. Challenges and criticisms. Compliance costs. Critics argue that the compliance costs associated with SOX can be burdensome for smaller companies, potentially stifling innovation and economic growth. Overemphasis on formalism. Some contend that the focus on strict compliance might lead to a box-ticking approach rather than fostering a genuine commitment to ethical business practices. 6. Global impact and influence. International adoption. While initially a U.S. legislation, SOX has influenced global corporate governance standards, with many countries adopting similar principles to enhance transparency and accountability. Cross-border listings. Companies seeking cross-border listings often find compliance with SOX a prerequisite, reflecting its influence beyond U.S. borders. 7. Evolving regulatory landscape. Post-enactment amendments. Over the years, there have been amendments and adjustments to SOX to address evolving challenges and ensure its continued relevance. Ongoing relevance. SOX remains a cornerstone in the regulatory framework, influencing subsequent regulations and guiding corporate governance practices. 8. Conclusion. Legacy of accountability. The Sarbanes-Oxley Act, born out of a necessity to restore confidence in financial markets, has left an indelible mark on corporate governance. By instilling a culture of accountability, reinforcing internal controls, and influencing global standards, SOX continues to shape the way businesses operate and report their financial affairs. As corporate landscapes evolve, the principles embedded in SOX serve as a beacon, guiding organizations toward greater transparency, integrity, and sustained investor trust.